Welcome back, Jeff. Happy New Year.
Yeah, happy New Year to you. It's great to see you again.
Doesn't feel like it's just been a month in January, right? Feels like it's been like, I don't know, it's been a very action-packed start to the year.
Yes, it has been.
So, what are you looking at right now? Is it oil still and gold? And like, what's your favorite things to look at? Obviously, there's sanctions, there's Trump in the White House. There's a lot of things to talk about, but like, and of course, AI.
Mhm.
With everything that's gone on over the last week or so, or like late Jan. But where's your headspace at?
My head is on the fact that we have just completed the longest period of stable oil prices since 12, 13, and 14, and we know
Oof.
how it ended.
Oof, yes.
um, However, let's talk about what happened to gold over that time period. Gold collapsed.
Yes,
Gold collapsed before oil collapsed. What did gold do over the last 30 months? It's gone straight up.
straight up.
What finally broke us out of that pattern? It was supply. I tend to think supply is going to break us out of this holding pattern in the same way. Um, but I think there's a bigger question here to ask is look at the level of backwardation in this
Yeah.
market. Physically, your inventories are at relatively low levels. You haven't had any reserve replacement. Demand continues to grow. We can talk about spare capacity later. That's usually a pretty bullish setup. Why won't this market move?
But that's the question. It's impossible. Like we almost started to see it move a little bit, right, towards the end of the year, and I will say, we've really defied consensus. We've called for like $80 this year. You and I've talked about it.
Mhm.
Everybody was talking about 60 or 40, and so on. But it kind of got there, and now it's kind of retracing again. People are still not convinced by Russian sanctions or the fact that Iranian sanctions could tighten. I've been in Saudi Arabia twice in the last kind of 2 months, and the message from them is very clear. We're not preempting anything. We remember what happened in 2018 with Trump
Mhm.
saying he's going to not give waivers, then he gave waivers. In 2022 with the Russia sanctions, which were never really implemented, they've been burned twice, but yet like, there's something in the market that just won't look at these facts, look at the backwardation and flat price. I mean, we're $77.
So let's go back 30 months ago when this happened. It was basically somewhere in October, November of 22. Market's just flatlined
Yeah.
since then. Investors left. And it just wasn't oil. It was a lot of different other assets. And what happened over that time? Rates went up. And I would say, what am I focused on right now is bond equity correlations. They
Right.
flipped for the first time in nearly 2.5 decades, 25 years. So up until actually September 11th, 2001, bond and equity prices were basically negatively correlated, meaning the returns were positively correlated. So if growth went up, you sold bonds and bought equities. All of a sudden, after September 11th, we just started buying bonds and equities in a synchronous fashion. Why? Interest rates collapsed down to 1%, liquidity flooded the market, and around 0405, we started that terminology, risk on, risk off.
Yeah, exactly.
You no longer, at 0% interest rates, there was no choice. The question was, how much were you going to lever up on bonds, equities, commodities, in all the, so everything moved in tandem. Hence, you had risk parity and all of those different trading strategies. And I think what's happened here is, hey, interest rates went up, leverage left the system, inventories have been depleted. You're delevering everything at this point right now. And so the question is, can oil go up without the leverage? And I started doing this, at least I started it at Goldman in 95, 96. And if I challenge everybody to go back and look at a chart of backwardation and inventories in 96, look just like today. You had, a dollar level of backwardation on the front end of the curve, no inventory, and the price was $18 a barrel. It would not move.
Yeah.
And if you think about that time period, you had 6-7% interest rates. There was no leverage. There was no hedge funds in this market. I remember it was Dwight Anderson in 2004. He was the first commodity hedge fund, first one ever. You look at the world right now, there's no more commodity hedge funds. There's no more leverage in the system. And actually, trading doesn't make any money anymore. And what was driving the markets? They were deal makers and things of that nature. And I think we're going back to a world similar to where we were in that environment. Also, one thing we invented, back in the 90s in that environment were commodities as a diversifying asset. So let's go back to, if bond equity correlations are now in the old world, going back 30 years ago, where growth, instead of risk on, risk off, growth goes up, you sell bonds, you buy equities. And by the way, in that sell-off in AI that happened on Monday,
yeah.
It did it. Basically, it was like the old world again, where, hey, AI is going to hit growth, and
therefore everything.
Yeah. And so it was, and I think that if we go into that environment where you have, think about what this is, from 2001 to 2022, it was all about the search for yield.
Yeah.
Because everything got crushed, everything was correlated. By the way, so if you have, make sure I say this right, if equities go up and bond prices go up at the same time, the returns are negatively correlated.
Right. Yes.
And if they're negatively correlated, you're naturally hedged. And if you're naturally hedged, what do? Put on more leverage. And so the amount of leverage in the system was absolutely enormous. So if we've taken that correlation and reversed it, you're going to end up having not only your interest rates higher, you're going to be using even less leverage than what you would otherwise. So we don't have any more leverage in the system. So who's going to step in and buy this thing anymore?
Yeah, so Nikki, Dr. Nikki Ferguson, he heads up our quant service, right? And he's been highlighting through his research a lot, interest rates coming down had improved the liquidity factor to an extent, but still so much of the trading, it's just changed. To your point, he's been highlighting far more relative value trades rather than flat price. And you can even see in the trading houses, everybody's going for the physical asset rather than, trying to kind of do the more simplified, this is flat price, let's just put the money in. And I do think that just gives us a very different paradigm for price discovery. What is the true price of oil when you're Dubai has been $5 backwardated at the front and we're flat price $77, right? There are definitely questions about that. But one thing you said, which is very interesting, right, in terms of higher interest rates, but we know the US president in particular, he's already called for OPEC, you must lower the oil price. And by the way, therefore, central banks around the world must cut interest rates. How do you see that playing out? Because that's going to be pretty volatile, I reckon, over the course of the next couple of years.
I think the best place you can focus on is going to be in the dollar. It should get, his tariff policy should be reflected in the dollar. And you should also see, sanctions and things of that nature reflected in the dollar. In fact, if I were to go, what are the three big drivers in 2025 and beyond? I go, one, low inventories. We're going back to, if you remember the term back in 1995, 96, it was just-in-time inventory.
Yes.
You haven't heard that term in a really long time. So as risk on, risk off go out the door, we go to just-in-time inventory. So everybody's looking at the inventories. Why would this thing go up? And I think that, we go in that, it means we've seen destocking for supply and demand reasons, but we've also seen destocking because of cost of capital reasons. So the market's going to be extraordinarily vulnerable to sentiment shifts. And then it probably potentially have to restock. So I think that's one big factor that's going to be there. And I think that is part of this whole liquidity thing. It's a liquidity growth trade-off. And you can think about from 2001 to 2022, the growth liquidity mix always favored liquidity.
Yes.
And so growth was down. So growth was not a factor. All you needed to have was growth come in. You moved out of cash and went into all risk assets, hence why we called it risk on, risk off. Now, growth is going to be more important than liquidity, because let's think about, what is Trump trying to do? He's going into the U.S. and he's going to hit the current account, the goods account. Yeah. He doesn't want them coming in. By the way, that's going to hit the capital account. Has to. And if it hits the capital account, you have less money going in, you have a weaker dollar, which should be supportive to overall commodities, which is why I go, okay, what is your one sufficient statistic you need to look at in terms of that, your question around, tariffs and Trump in general,
everything Trump in general.
it should all be captured in the dollar.
Yeah, and I think that's we've seen it strengthen a lot, given everything right now is inflationary. But I do think there's a lot of trade-offs, right, between like what he's talking about versus what he is going to achieve. But sticking to Trump, I think, the biggest difference between Trump 1.0 versus Trump 2.0 is U.S. production was growing at 2 million barrels per day, 2016 to 2020, like prime time.
Yeah.
Now, at best, 400,000 is what our estimate is, 200 exit to exit, but annual average. There are companies telling us it'll be even less. There is a question mark. I'll come back to it because apparently private equity is gearing up to put more money into US shale space. Maybe that's worth talking about. That's kind of one big shift because he keeps talking about drill, baby, drill, but you can drill as much as you want. If the geology isn't there, it's not going to help.
Yeah.
The second thing I feel the market's really underappreciating is his relationship in the Middle East, right? I think the Middle East is in a very different place right now. Saudi Arabia, and like I said, they will just not make the same mistakes as 2016, where the policy, especially with Prince Abdulaziz, like he is very, very transparent and he's like, okay, this is what we're going to do. And it's not just about him, it's the 8 OPEC plus members. But those two are significant differences because he had 2 million barrels per day of US shale behind him, growth every year, and he could pressurize Saudi Arabia and OPEC plus to increase production preemptively. If those two are gone, do you not see this oil market being like super tight at some point this year?
Yeah, I see it super tight. I'm not so sure the price is going
to I'm with you.
By the way, but then again, let's go. If you're long and you're the returns and you're rolling the front month of Dubai, buy the best returns from owning commodities. We're in the 90s, not the 2000s. I think the key point here is from owning oil and commodities, these things are great. I don't think it's going to be reflected in the price.
Flat price, exactly.
Because was the flat price going up in the 2000s just a reflection of liquidity?
Yeah.
In the actually leverage-driven liquidity, and the leverage is gone out of the system, so the flat price stays the same. But the returns to the investor of being in that space, I think, are going to go up. Now, going to your question about, Trump and drill, baby, drill, I absolutely agree. He can't control the bond market and he can't control physics. That's, nothing he can do. And here's the point I like to make, and I saw a chart of it actually the other day, is the world was greener under Trump 1.0 than it was under Biden. And it's already baked in. It's going to be greener under Trump 2.0 than Biden because you've already, you have that investment in solar panels and everything. It's all going to come in. So,
it's the cycle.
So he can talk all he wants. He's going to get more green energy and less brown energy under his regime than what Biden. And actually, I like to go back to the point. Biden talk about being green. He brought it to 20 million barrels per day of oil production. It's the largest oil producer in the world.
Yeah.
I just think, okay, we can talk about it. So both of them can talk all they want. But I think the reality is he's going to have a really hard time getting production higher. So if we go back to, the three dynamics to be really structurally bullish oil, 1, low inventories, we have it. 2, no reserve replacement. No, we don't have a reserve replacement. Plus, we have the demand growth on top of that. So you're short on reserves. The third is spare capacity.
And who's controlling it, right? The market gets obsessed by that. Even today, there's an article, OPEC has this much spare capacity. I'm like, ask the question, who is controlling that spare capacity, right? But people don't do that. But, to be fair, Trump talked about trees yesterday. He's like, we would like to plant more trees. So yeah, you're right about the green versus the brown. But are you seeing private equity kind of push more into US US shale oil side?
At this point, the answer is no.
Okay.
I think the jury's out. We'll see what happens. I think the focus is still more on green assets. We'll see how that changes. But I think in general, it's the whole space, whether if it's green, brown, suffers from the fact that the returns just aren't
just not there.
It goes back. I think if you got great returns in oil and all that money that was sitting in NVIDIA moved over to oil, the whole space could go up. but the problem is on a ball adjusted, you're talking about really big returns. And you saw, hey, people just bought the sell off in Nvidia this week. They didn't.
Yes.
I thought, oh, maybe we'll get some rotation.
That's
Finally, some
exactly
pricing power
what,
come to
yeah.
our direction.
We
But
thought the same thing. Oh, Nvidia comes off, you're going to see money coming into commodities,
yeah,
energy. Nope.
no,
Just went, it kept
yeah.
went straight back into
And
it.
I
Yeah.
think the other thing is I don't think people know. I think they're confused around energy transition, and I think that just makes them want to stay away from the space. Do I buy brown? Do I buy green?
Green, yeah.
And yeah, here's the take on this, and I think people forget is energy transition started in 1973 when Nixon kicked off his energy, or was it Project Independence? And here's the irony of it all. From 1973 to 2015, energy transition was driven by the fear of running out of oil.
Yeah.
And from 2015 to now, it was driven by the fear of too much oil.
Yeah.
And I remember it was right around 2016. I was sitting in this TV interview, and they go, "What's your view on peak oil?" Oh, what's peak oil mean? Peak supply or peak demand? And
Yeah.
and I think that this whole, and actually, here's a stat that I love to point out. The speed of energy transition when it was driven by the fear of running out of oil was faster than the energy transition that
When there's too much oil. By
much.
definition, right? Yeah, absolutely.
And so, let's call it the net zero 2050. And by the way, those assumptions, that were put out by the IEA, I don't think they ever intended on that taking the life that it did. I think it was just.
The media doesn't help.
Doesn't help. It was an impossibility. And if you ask me, what is the third thing I'm focused on in 2050 is the fragility of supply chains, every commodity. And let's talk about, the Dunkelflaute in December. It was like, or at least I was on a beach in warm weather when the Dunkelflaute hit Germany. For those who don't know, my German is terrible. Dunkel is dark and Flaute is no wind.
No wind.
So it's dark, no wind, you have no salt, and it's really cold out. So three conditions. And by the way, it went on for 2 weeks. And, power prices went to 1,000 euros a megawatt hour in that environment. But I think the key point there is you can't take renewables up to those levels. They went up to like 56%. Because the batteries can't last long. They didn't have enough storage to get through it. And by the way, this morning, the Norwegians are going to cut the power cable. So, it created a lot of unstable dynamics there. And now if the Norwegians are going to, whatever they want to hypothetically cut the power cable to Germany because they didn't want their power prices going up much because of what they feel were irresponsible decisions taken on the continent, then you got a problem. But here's the thing that you learn from that Dunkelflaute is that the supply curve from renewables is backward bending, meaning that you can when the wind blows, you can deliver power when you can produce it. You cannot deliver power when you need it.
Need it, yeah, absolutely.
And that I don't think was thought through 5 years ago when you had that net zero 2050 push.
I would say, Jeff, even now, so we've always had a North American power service, and I think it's very different, right, when you're talking in the US about it. We've launched our European power service last year. And the exposure we're getting, it's been one of our fastest growing services, and the conversations we have with policymakers, I don't even think it's 5 years ago. Even right now, they don't understand the issues with base load, like what you need. And the point, like you said, if the wind isn't blowing, you can't produce the power. And there's still a lot of talk about, but technology will help us bridge that gap. There's some areas of sensibility, but I still find Europe is grasping at the utopia of like a fully renewable grid.
Yeah, but I think we are technology. We can't survive or supply that right now. But what it tells you, I think, in terms of investing in energy going forward, is invest in the assets that can cater to the consumer, that deliverability, and so we'll continue that. if the road to travel on energy transition started in 73 and you've gone through that, you're not getting off that highway. And by the way, the Chinese, they're on the accelerator. They're, and the other thing too about the Chinese, they're building nuclear capacity at, unprecedented rate. The
Absolutely.
technology is being used everywhere. And from a national security perspective in places like US and Europe, you have to continue, because if you fall behind the Chinese,
Then you just know, politically.
yeah. So I think, what's happening is, if you think about energy, you have energy security followed by competitiveness, followed by the environment. That's your natural ordering of things. And what happened in 2019, environment got put above the other two. And all we're going to do is return security and competitiveness back to the natural ordering, which, by the way, again, I want to emphasize, created a faster energy transition than the one that we saw recently within the environment being at the top. But I think from an investment perspective, it means target things that are going to be able to deliver energy when you need it, not when you produce it, which is batteries, storage, chemical storage, things of that nature, gas peakers. Most of less polluting oil. I think it all falls into that category.
But so coming back, because last question, because what you said, like the real reason for the rally in prices in the 2000s was liquidity, right? Like that, there was a lot of liquidity in the system. But if that liquidity is no longer there, do you think these other kind of investments can still give you the returns, even if oil prices don't?
Absolutely. And I think, let's go over the levelized cost of energy. And let's think about the returns. Okay, so levelized cost of energy out of solar and wind has collapsed. It's the cheapest source of energy from an LCOE basis. By the way, the ROE of it is the worst. Let's go back to the fact that the wind and solar cannot deliver into the market when it's in a deficit. So it'll never be able to get that €1,000 megawatt. The battery can, but, and so the return on equity is, even though it has the lowest LCOE, is lower. And so the focus, and this kind of goes to the roll yield, and in the 90s, how you had great returns, it's going to be a focus on the ROE. So maybe the LCOE drags down the overall cost level, but the gas peaker is going to be delivering into that market at that €1,000 megawatt hour. It's going to be printing returns, despite the fact that it has a higher LCOE. And I think that that's really the message here is one, focus on the being able to, on the consumer and their needs. Actually, if somebody said, you need to entice them to decarbonize. If they want to decarbonize, they will decarbonize, and it needs focusing on their needs. And I think the second thing is focusing on profitability, return on equity. And then the third one is, then it creates alignment across businesses, so businesses can go out there and be profitable. But I think it starts with focus on the consumer. By the way, if you really read behind the lines of what I just said, those were the criticisms of communism in like 19 whatever. They would make too many red dresses when the people wanted the blue dresses. They didn't focus on return on equity. They focused on, the levelized cost of energy. And then you had misalignment in incentives. And I think one last point on the super cycle, still a believer in the super cycle thesis. Because what is a commodity super cycle? It's a CapEx cycle. We're seeing it. CapEx booms are going everywhere. Why do you not see it in the market? And I think here's the difference. And this goes to my number 2 thing about focus on returns. We had policy push driving that investment, and you ended up with malinvestment. We got to make it market pull driving. And so in my head, we had that super cycle in the 2000s was demand pull. It was economics doing it, not policy push. And the policy push creates malinvestment. So if the thesis during the 2000s was one of underinvestment, this one's malinvestment, which means you're going to have pockets of deficits and surpluses all over the place. And that's why, it's like I point out, Spanish power prices can be negative in the morning and plus 250 in the afternoon. And I think that's that kind of supply and demand deficit that characterize this super cycle. I think of the other way I'd like to call it is a bubbling cauldron of supply and demand imbalances, and it's just little ones here and there and there, and which makes it, I guess more of a, going back to what you were saying, it won't create that big steady super cycle. It's going to create great returns,
Yeah.
but it's going to be more micro oriented.
Fantastic note to end at. I think it's going to be fascinating year. Yeah, I feel more positive as well about, and I think, again, to your point, taking out some of the policy push will actually help us find a better equilibrium. Obviously, we've got IE Week coming up, so we will see you there at our
Looking
event.
forward to it.
Yes, I'm sure there will be so much more in just a month's time, a
Yep.
few weeks' time rather, to talk about, given what January has showed us already. So thank you again, Jeff.
Great. Thanks
See you
for having
soon.
me.
Yeah.